going to do something a little different in this video. Instead of telling you how to build a great portfolio, I'm going to tell you exactly how to destroy one, step by step. Because here's the thing, most of the ways people blow up their money aren't exotic or complicated. They're the same handful of mistakes repeated over and over. And right now, in this specific market, the conditions are set up to make every single one of them worse than usual. So consider this a field guide to financial self-destruction. 7 mistakes. And as I go through them, I want you to do something uncomfortable. Quietly ask yourself how many of these you're currently making. Because I'd bet most people watching are making at least 2 or 3 without even realizing it. Let's count them down. I'm Daniel Ayala. I manage a fund professionally, and a big part of that job is not the exciting part. It's the boring discipline of avoiding unforced errors. Because here's a truth most people don't want you to hear. In investing, you don't win by being brilliant. You win by not being stupid at the wrong moment. Avoiding the big mistakes matters far more than finding the perfect stock. So let's talk about the mistakes. Counting up from 7 to the single most destructive one. Number 1 is the one quietly wrecking the most portfolios in this exact market. Number 7, paying attention to the wrong number. Most people watch their portfolio's daily value and completely ignore the things that actually determine their long-term returns, their fees, their taxes, and their asset allocation. They'll obsess over whether a stock is up or down 2% today and totally miss that they're paying high fees every year, or getting hammered on taxes by trading too frequently, or that their whole portfolio is secretly one giant bet on the same thing. The daily number is loud and emotional and almost meaningless. The quiet numbers, fees, taxes, allocation, are silent and boring, and they're what actually decide whether you end up wealthy. Watching the wrong number is mistake number 7, and it sets up almost every mistake after it. Number 6, buying something because it already went up. This is called performance chasing, and it's one of the most natural and most destructive instincts in investing. You see a stock, a sector, a fund that's up 200% this year, and your brain screams, get in before I miss more. But think about what you're actually doing. You're buying something after the gains have already happened from the people who are now selling to you. You're arriving at the party as the smart money is calling their cab. The pattern is brutal and it's everywhere. People pile into whatever's hot right near the top and then write it down. If your reason for buying something is it already went up a lot, that's not a reason. That's the setup for mistake number 6. Number 5, thinking you're diversified when you're not. This one is sneaky, and right now it's catching millions of people. A ton of investors think they're safe because they own an index fund. I own the S&P 500. I'm spread across 500 companies. I'm diversified. Except here's what's actually happening in this market. The 7 companies, the big tech giants, Apple, Microsoft, Nvidia, and a few others, now make up around 35% of that entire index. 35% in 7 names. So when you buy the diversified S&P 500 today, more than a third of your money is riding on one theme: big tech and artificial intelligence. That's not diversification. That's a concentrated bet wearing a diversification costume. And the danger is you don't feel the risk because it's hidden inside something that sounds safe. Not knowing what you actually own is mistake number 5. Number 4, letting your emotions place your trades. Here's the pattern that destroys more portfolios than any market crash ever has. When markets are soaring and everyone's euphoric, people get greedy and pile in at the highs. When markets are crashing and everyone's terrified, those same people panic and sell at the lows. Buy high, sell low. The exact opposite of what works. Driven entirely by emotion. And it feels right every single time. Buying feels great when everything's going up. Selling feels like relief when everything's falling. That's the trap. Your emotions are almost perfectly designed to make you do the wrong thing at the worst moment. If your buying and selling decisions are being made by how you feel that day, you've handed the controls to the one part of you guaranteed to crash the plane. That's mistake number 4. Number 3, having no plan for when you're wrong. Most people spend all their energy deciding what to buy and zero energy deciding what they'll do if it goes against them. No exit plan, no predetermined point where they say, I was wrong, I'm out. So when a position starts dropping, they freeze, and then they do the worst possible thing. They start hoping it'll come back. I'll sell when I'm back to even. Then they turn a small manageable loss into a catastrophic one because they had no plan for being wrong, and hope became their strategy. Here's the professional truth. You will be wrong regularly. early. Being wrong isn't the problem. Having no plan for when you're wrong, that's mistake number 3. And it's the difference between a small bruise and a broken account. Number 2, using borrowed money to amplify your bets. This is leverage. Trading with money you don't actually have, borrowed against what you do, and it's the fastest way to turn a bad month into a total ruin. And I'm not talking about this hypothetically because right now the market is swimming in it. Investors have borrowed around $1.5 trillion to magnify their stock bets. And Goldman Sachs is warning that this borrowed money is dangerously concentrated in exactly the AI stocks everyone's crowded into. It gets more extreme overseas. In some markets, people are buying leveraged funds that make double or triple bets on single chip names. And those funds exploded from $3 billion to over $10 billion in under a month. That's borrowed money. Betting on borrowed money, and here's why it's so lethal. When leverage goes wrong, you don't just lose some. You can lose everything and fast because the losses are multiplied, and the moment your bet drops too far, you're forced to sell at the worst possible instant. Leverage is how people go from rich to wiped out in a single bad week. It's mistake number 2. And the reason it's not number 1 is that at least leverage is dramatic. The number 1 mistake is quiet, and almost everyone is making it right now. And number 1, the most destructive mistake of all, trying to predict the market instead of preparing for it. Here's what I mean. Almost everyone approaches investing as a prediction game. They think the whole point is to figure out what happens next. Will the market crash? Will AI keep going? Will the Fed cut rates? They pour all their energy into guessing the future, and they position their entire portfolio around whatever they've convinced themselves is coming. And then reality does something they don't predict because nobody can reliably predict it, and their whole setup falls apart. This is the mistake underneath all the others. Performance chasing is a prediction. Panic selling is a prediction. Piling into leverage is a prediction. A bet that you know what's coming. It all traces back to the belief that the game is about being right about the future. But the best investors I've ever studied don't think that way. They don't try to predict the future. They try to be prepared for many possible futures. They ask, what if I'm wrong? What if the opposite happens? Is my portfolio built to survive that? Not just to win if I'm right. They build for resilience instead of betting on prophecy. And that one shift from predicting to preparing quietly separates the people who last for decades from the people who get wiped out the first time the world surprises them, which it always eventually does. Trying to predict instead of prepare is mistake number 1. And if you take nothing else from this video, take that. So there they are, 7 ways to destroy a portfolio. Watching the wrong number, chasing what already went up, fake diversification, emotional trading, no plan for being wrong, borrowed money, and the big one, predicting instead of preparing. Notice something about all 7. Not one of them is about picking the wrong stock. Every single one is about behavior, about discipline, structure, and managing yourself. That's the real secret nobody wants to hear. Investing success is mostly not about intelligence or stock picking or predicting the future. It's about not sabotaging yourself with these 7 completely avoidable mistakes. The market doesn't usually destroy portfolios. People destroy their own. One of these 7 ways at a time. And the good news in that is empowering because every one of these is within your control. You can't control what the market does tomorrow. You can completely control whether you're over leveraged, whether you actually know what you own, whether you have a plan for being wrong. The whole game is played on your side of the net. If this kind of breakdown is useful to you, the honest, no hype version of how this actually works, that's exactly what I put in my free weekly note. Every week, I take what's happening in the market and translate it into clear thinking you can actually use, including how to sidestep the kinds of mistakes we just went through. No predictions dressed up as certainty, no fear. Links in the description. And I'll leave you with a small challenge instead of a question this time. Go look at your own portfolio tonight, honestly, and count how many of these 7 you're currently making. Not to feel bad, just to see it clearly, because you can't fix what you won't look at. And the investors who get better are the ones willing to catch themselves in the act. That's the whole discipline. And I work on it right alongside you. If this helped you spot a mistake before it cost you, share it with someone who might be quietly making a couple of these too. The more people investing with a clear head instead of on emotion and hype, the better off everyone is. I'm Daniel Ayala. Thanks for watching. I'll see you in the next one.